Late last year, I dropped this article onto the blog, and it was an exploration of the relationship between mindfulness and its effect on athletic performance. My thinking being that given that there is overlap in the psychology of athletes and traders, that if mindfulness was shown to be effective for athletes, then by extension it would have application to traders. And what was found was that mindfulness is of use to athletes and does improve athletic performance. Therefore, it's logical to assume that mindfulness in and of itself would help with traders and their performance. But before going on, a little refresher. Mindfulness is simply defined as a mental state achieved by focusing one's awareness on the present moment while calmly acknowledging and accepting one's feelings, thoughts, and bodily sensations. And it's used as a therapeutic technique. So, in effect, you are an observer of what is happening to you, what you are thinking, and what you are feeling. And you do not react to those. You do not make a judgment about them. You simply observe that they are occurring. When I went back and I was having a look at the literature, I actually found that there is actually a study out of Thailand from 2016 that does actually look at mindfulness within the environment of trading. And I came across this study, and it's titled, "Does Mindfulness Enhance Stock Trading Performance? The Moderating and Mediating Effects of Impulse Control Difficulties." What these authors set out to do was to look at the notion that within the field of trading, perhaps the number one issue that acts as an impediment for traders, and this has certainly been my observation over many decades, is their inability to control their emotions. I often say that trading is simple, but it is not easy. The rules around trading are very, very simple, and they can be characterized thus. If an instrument is trending up over the time frame in which you are trading, you buy it. If an instrument is trending down over the time frame in which you are trading, you sell it, and you do not bet the farm. Despite those very, very simple rules, it seems that the majority of traders cannot follow them. And they cannot follow them for the simple reason that they lack impulse control. They have an inability to control themselves, so that their actions are reflexive and not reactionary. And by reflexive, I mean they simply jump at shadows. They're unable to stop their behaviours from interfering with their trading. Let me give you a simple example. Let's assume you are long a position, you have a stock in place, and normal market volatility causes the price of your trade to move back towards your stop. The impulsive way to respond to that is simply to kill the position, to remove it from your ledger, and therefore remove yourself from the emotional distress of watching a position come back and hit your stop. But the problem is when you look at positions that are very, very profitable over the longer term, you see that there are innumerable instances of positions moving back towards a stop, not hitting it, and then moving on to make higher and higher highs. It is this reflexive panic notion that drives much of the impulses of traders. And it is this that the authors of the study sought to examine and sought to see whether there was some way of modulating that and dampening it down. Because it's recognised the difficulty that traders have is this notion of dispositional bias. We all know that as an accessory rule in trading, what you are supposed to do is to cut your losses and let your winners go. Poor traders, and that is the majority of traders, do the reverse. They let their losers go and they cut their winners. So it is impossible for them to be profitable. And in looking at this broader question, the authors had a series of hypotheses that they wanted to look at. This notion of impulse control difficulties reducing stock trading performance. Mindfulness reducing impulse control difficulties. Mindfulness increasing stock trading performance. And impulse control difficulties mediating the relationship between mindfulness and stock trading performance. And impulse control difficulties moderating the relationship between mindfulness and stock trading performance. Traders with high impulse control difficulties would benefit from mindfulness more than those with low impulse control difficulties. This final hypothesis is interesting, and something interesting popped up in the results that I'll talk about at the end. To look at this issue, the researchers attended a trading fair. Think of something like an ASX Open Day, a money show, or an ATAA conference. And what they did was they polled 73 professional traders. These were brokers, analysts, fund managers, and 120 independent traders. You could think of the independent traders as, let's just say, your ordinary punter who had attended the show to further their education, to get exposure to more sources of information and knowledge about the market. In terms of the demographic, and this is a little quibble I had with the study, and it's not a major one. When I looked at the trading experience, I found that 76% of traders had less than 3 years' experience. This to me means that you will get a drift towards those who have a lack of impulse control, because immature traders tend to have that problem. Trading is quite Darwinian in that it will weed out those with behavioural difficulties. Those who cannot control themselves will be knocked out of the market simply by virtue of their own behaviour and the impact that has on its performance. The researchers then looked at the notion of how these traders performed, and they were given a series of separate questionnaires that looked at 3 different things, performance being one. So performance was broken down into recent gains and losses, and these were quantified and placed into buckets as to how much they had made or lost recently. Again, a slight quibble with this sort of methodology, because my view of trading returns is that we have this short-termism. People will say, how much did you make this month? And my response to that is generally, come back and ask me in a year. Because if you're not thinking in terms of longer term, then you've got the wrong idea about what trading is. It is a small quibble, and I don't think it dramatically impacts what they found, but it is something to be aware of. In terms of how mindful the respondents were, there is a standardized test which is known as the Mindfulness, Attention and Awareness Scale. And this is, as the name implies, simply a scale over which you measure an individual's mindfulness and their attention to their mindfulness, their inner awareness. And this is a standardized test that is used. The third arm that they looked at was this notion of impulse control. And impulse control was measured by offering a series of statements and getting the respondents to rank how they felt about these or whether this was their mode of behaviour. And it was these 4. When I am upset, I lose control over my behaviours in stock trading. When I am upset, I have difficulty controlling my behaviours in stock trading. When I am upset, I become out of control. And finally, I experience my emotions as overwhelming and out of control. And they had to give a ranking to each one of these. As you would expect, they were able to support each one of their hypotheses, this notion that, as a generalized statement, that mindfulness improved trading performance. But there's a little caveat that I'll come to in a moment. And they generated this neat little chart. Now, I've modified this slightly just to make one of the return arms more visible by colouring it in orange. And what you can see is that people with very low impulse control difficulties as a whole did better over trading. Those with high impulse control difficulties did poorly. But I said there was a caveat. And the caveat is it appears that mindfulness tended to lower trading performance of individuals who did not exhibit the impulse control difficulties. So if you ranked very well in terms of your impulse control, mindfulness tended to pull your performance back. The rationale for this offered by the authors was this notion of simple behaviours versus complex. Mindfulness works best for complex behaviours where you step out of the decision-making process for a moment, you adjust, you reassess, you make a decision. Traders who are successful tend to have trading as a simple process. So mindfulness acted as an impediment in the decision-making process. It interrupted their train of execution. So that if you had a simple method that was clearly enunciated, clearly set out, and worked in a logical framework, introducing another step such as mindfulness caused that to come apart a little bit and it reduced your performance. I would add an extension to that and probably say that people with very good impulse control probably to some degree demonstrate mindfulness as a trait. It is software that already runs on board. They don't need to add it as an addendum to their emotional or psychological arsenal. So it's already hard-coded in them. And when you attempt to layer that over an existing, what for them is a normative behaviour, you begin to run into problems. So the upshot of the study is a simple one. It is this notion that mindfulness as an activity, by and large, for the majority of traders, and I will state that the majority of traders are poor traders, in that their results are not optimal for what they're attempting to do, would benefit and do benefit from mindfulness. This raises the notion of resources. And the authors, during the presentation of this paper, often make reference to John Kabat-Zinn, who is, I don't want to say one of the founding fathers of mindfulness, but he is one of the landmark figures of mindfulness. And these are two of his books that I would recommend that should be part of a trader's library. These are an extension of the books I mentioned earlier on for the athletic performance. And it's worth mentioning them again because in trading books are all the same. Trading books address the problem of this is what a moving average looks like, this is what a trend line looks like, and they all replicate that over and over again. And there's nothing to be gained by buying more and more of those. But there is something to be gained by reviewing your own internal software, because your own internal software is quite malleable and can be altered in ways that are effective in helping you achieve what you want to achieve in trading. I understand that there is a vast population of traders who are resistant to trading psychology. And my only response to that is, well, everyone's opinion of the worth of a technique or not is not equal. And so if your view of trading is that it is simply this notion of what colour the screen is, what number is my moving average, what new tool indicator should I use, well then your trading will remain forever ordinary. Because in any endeavour that is individual and is high performance, it is the software that drives the trader and not the software that drives the trading program that at the end of the day makes the most difference.